Hello, good evening, good morning, and good afternoon, everybody, from wherever you are. On behalf of the City Equities team, I welcome you all to this earnings call of Nykaa. We have the pleasure of hosting the entire Nykaa management with us today. We have Falguni, MD and CEO of Nykaa, Anchit, CEO of Nykaa Beauty, Adwaita, CEO of Nykaa Fashion, and Arvind, CFO of Nykaa. Nykaa, as you all know, is India's leading lifestyle consumer tech platform with a diverse portfolio of beauty, personal care, and fashion products, including own branded products. The company listed on the Indian exchanges around 3 months back, and this is their second earnings call. So thank you and welcome to the team. Over to you, Falguni.
Yeah, thank you very much, Sugata. It's a real pleasure to be here today with everyone and be able to share our third quarter results for the year ended for financial year 23, March 23. Our consolidated GMV grew 26%. I'll just start with our consolidated GMV. The first slide, please. So our consolidated GMV grew by 26% sequentially and 49% year on year to 2,043 crores in quarter 3 of 22. And this is almost 83% growth on a year-to-date basis. Within that, our beauty and personal care GMV grew 29% quarter-on-quarter and 32% year-on-year, and it is at 1,533 crores, and this for the third quarter 22, and this is a growth of 58% on a year-to-date basis. Fashion GMV grew at 17% quarter-on-quarter, 137% year-on-year to 510 crores, and it now contributes almost 25% to our consolidated GMV. And fashion business has grown at 236% when we look at it on year-to-date basis for the 9-month period. I wanted to point out that the third quarter is sequentially one of the best quarters from a beauty perspective. Fashion, however, doesn't see such a strong momentum. It is a strong quarter, but sometimes the fashion momentum also continues beyond that into the first quarter, which is January to March quarter. On the average monthly unique visitor basis, the beauty and personal care grew by 4% quarter-on-quarter, 39% year-on-year, with 22 million unique visitors. And for the fashion vertical, this has grown 1% quarter-on-quarter, 120% year-on-year, with 16.4 million unique visitors in the third quarter of financial year 22. On the annual unique transacting customers basis, BPC vertical grew by 9% quarter-on-quarter, 44% year-on-year to 7.9 million at the end of December. And the fashion vertical grew at 23% quarter-on-quarter, 278% year-on-year, and about 1.6 million unique transacting customers for the third quarter of 22. And with this, the consolidated revenue from operations grew at 24% quarter-on-quarter, 36% year-on-year at 1,098 crores. And this is about a 65% year-to-date growth for the financial year-to-date 22. Now, I just wanted to point out a couple of things, interesting things. You will see that the difference in GMV growth at 83% versus revenue growth at 65%. That, to a certain extent, is also a function of the increasing share of fashion, which from a financial perspective reports its business differently, where the revenue only includes what we call a stake rate or commission from the business rather than the sales. Whereas in the beauty business, where our business is inventory-led, the revenue includes the sale of products. So this is one important aspect of our business that I wanted to point out. Moving on, I'll pass on to Anchit to talk about the beauty business. I think this is just a slide on consolidated GMV, which kind of translates the same numbers that I talked about in the first slide, where we are talking about almost 83% GMV growth over a 9-month period. And we are talking about, this compares quite favorably to the previous year, which was a COVID impacted year. And we've also shared with you the quarterly numbers, where you can clearly see that quarter 1 had seen a huge growth because the previous year quarter 1 was very subdued because of COVID. However, since then, the growth has come back to more reasonable levels of 63% year-on-year growth in quarter 2 and 49% growth year-on-year growth in quarter 3.
Great. Thank you.
I hand over to Anchit.
Yeah, thank you very much, and a warm welcome to everyone who's dialed in for the call. So just some quick business highlights with regards to the beauty and personal care business for the quarter. So the first point I'd like to mention is Nykaa hosted its biggest annual sale event in the month of November. We call it the Pink Friday sale, and it went from the 24th to the 30th of November. And it featured the widest duration of 100% authentic products from over 1,500 brands that participated in this mega sale. These brands range from some of the best-selling and well-renowned international brands to homegrown staples. And this sale was conducted across the app, the website, as well as across all of our 96 physical retail stores. To announce the launch of the Pink Friday sale, the annual Pink Friday sale, Nykaa did a marketing campaign across multiple digital and social channels featuring our brand ambassador, Janhvi Kapoor, which invited viewers to get excited for what we refer to as the biggest haul of the year. During the sale, we also enabled certain new and interesting formats to engage our consumers, such as watch and buy and live streaming, live commerce. This is an interactive and entertaining gamified shopping format in which special deals were unveiled and the deals were valid for exclusively for the period of the live streaming session. This is a new initiative Nykaa has started in the past couple of months, and it is performing very well and leading to the kind of engagement with our consumers that we've always hoped for. Finally, the biggest beauty steal was a marquee event we hosted with an influencer called Dolly Singh. It was a big hit with our app users. They were able to watch the live stream on the app, and it helped them to discover the best of what the sale had to offer while watching entertaining content on the app. Secondly, Nykaa launched the Tum Hi Ho Nykaa brand film in the quarter to celebrate women who have scripted their own life stories. And we chose 6 women from very different backgrounds, 6 ordinary women across the country with extraordinary stories that we put out as a brand film. And this reiterates Nykaa's promise of being a true supporter for the self-expression and the empowerment of women. And this film was broadcast across TV, OTT, and social platforms. Third point to note is that our private brand, Nykaa Cosmetics, launched a new format of quick drying nail enamel called Nykaa Insta Dry. And we also introduced 100% natural hair oils to increase our market share in the hair category. And we further penetrated into skincare with the launch of our vitamin C serum, which is a very important and trending ingredient within the skincare space. So this shows you that our private brands are very active in all 3 key categories of hair care, skincare, and cosmetics. And we are launching new ranges and new products every quarter. Next, please. Coming to our .com business again, this was a quarter with some fantastic new international brands being launched on the platform. These include very well-known brands such as Sol de Janeiro, Elemis Skincare, 111 Skin, and Nude Sticks. These are some very well-renowned brands globally that were previously unavailable in India. And today these brands are found only on Nykaa.com as well as in our physical retail stores. Moving on to the 5th bullet with regards to our physical retail network. Given the return of customers into physical retail this quarter, with COVID kind of receding into the rear view mirror in the quarter, we managed to open 12 new physical stores, mid and large format physical stores, mostly in tier 2, tier 3 towns, such as Jodhpur, Rajkot, and Trivandrum. And that has brought our total operational store count to 96 as of December 31st. And this is spread across 45 cities in the country. Finally, I think the last highlight to mention for the quarter was Nykaa continues to expand its warehouse storage capacity, and we have created an additional 1.35 lakh square feet of warehouse capacity in the quarter across multiple warehouses. And this goes back to our goal to continue to ensure better and timely delivery to our consumers. We believe we are best in class, and we'd like to continue to ensure better and faster delivery times for our consumers with this warehouse expansion strategy. Next slide, please. So just a quick review of the numbers as discussed. This shows you basically, we've discussed some of these numbers, but just diving a little bit deeper, we received about 667 million visits for the 9 months ended in December of FY22, and that was a 43% growth year over year. If I look at Q3 FY22 on the right-hand side, we received almost 230 million visits in quarter 3 alone. Going to the bottom left chart, the monthly average unique visitors for the 9 months ended December was at 21 million, a 67% year-over-year increase from the 12 million which we received for the same period last fiscal. If I look at Q3 FY22, we received 22 million unique visitors who visited the platform over 230 million times. So the MAU visitor growth was at 4% sequentially, quarter over quarter, but 39% growth year over year for the quarter ended December FY22. Next slide, please. In terms of the number of orders that were shipped through the beauty and personal care business, we did about 19.7 million orders for the 9 months. This was a 69% growth compared to the 11.6 million orders we did in the same period last year. And for Q3 FY22, we processed over 7.6 million orders across our website and in our physical retail stores. On the bottom left-hand side, our average order values have remained strong at 1,963 rupees for the FY21, with a similar average order value for the Q3 FY22. So I think to summarize, our order volumes have grown 25% quarter over quarter and 31% year over year in Q3. At the same time, we've managed to sustain our average order values at this level. Next, please. So the number of annual unique transacting consumers through BPC stood at 7.9 million. This is a 44% growth year over year. And as of Q3 FY22, that number is at 7.9 million. In terms of the GMV grew at 58% year over year to about 3,804 crores. And on the right-hand side, you'll see that for the quarter, it was at 1,533 crores, which was a 32% growth year over year. And this strong growth in GMV has been supported by the growth in the transacting customers that I've referenced in the above table. Year to date, the FY22 growth at 58% is in part due to the base effect for the first half of FY21, which was COVID impacted. Next slide, please. And with that, I'll hand it over to Adwaita to take you through the fashion business highlights.
Hi, everyone. Pleasure to be speaking with all of you today. In terms of highlights on the fashion side, we'll kick off with 3 of the big initiatives we took on for the quarter. The first, and quite excitingly, we launched our first TV commercial. As most of you will know, fashion is a newer entity in our business, and so this past 6 months has really been about trying to create top of mind awareness and brand building. And so we launched our first TV campaign with our first brand ambassador, Alaya. And we do believe that this has increased top of mind awareness for the business. The second thing we did is we've actually kicked off an international brands portfolio. So we're traveling the world to try to bring the best fashion brands to the country. The first one that we kicked off with is a Swedish brand. It's probably one of the hottest European brands there is today, called NAKD. And it's picked up beautifully, and it's really just the start, and really excited to bring some of the best international brands to the country. The third highlight is that we're continuing to believe strongly in collaborations as a very effective way of marketing, particularly for our own brands. As you may know, we're a multi-brand retailer, but we have a very strong owned brand portfolio as well. We have 6 of our owned brands, and for these, we teamed up with some exciting personalities like Nikhil Thampi and Masaba Gupta for 2 distinct brands. Moving on to the numbers, we can first look at visits. It's been a hockey stick sort of in terms of visits when we look year on year. If we look at the 9 months that have just ended in FY22, we're talking about 328 visits. In the last quarter, that's about 115 million visits. And on a year-on-year basis, for these 9 months, we're talking about a 245% growth. In line with that, if we look at monthly average unique visitors, it's a pretty impressive number of 15 million visitors per month. Even when we look at that in light of the beauty business, this is a significant set of people who are now starting to know about the fashion business. And if we look at it as a year-on-year growth, that's 260%, when we look the year back. In terms of orders, we can see that the 9-month number is 3.9 million orders, which is 156% year-on-year growth. And if we look at average order value, this is a trend that, we've spoken about before, but we're seeing good premiumization across the business. This tends to be also seasonal, where the third quarter sells a lot of Indian wear and festive wear, which tends to have a higher average order value. But we continue to remain, focused on our average order value. We do feel that a lot of our unit economics stack up well because of this average order value, and this is a part of the strategy. Moving on, if we look at annual unique transacting consumers, so this is the trailing 12-month number, we can see, and I think, here the chart on the right is actually more illuminating. You can see that in this past quarter, our now annual transacting 12-month number is 1.6 million. And that's up from 0.6 million, a year ago. So this has also been a dramatic growth, both due to new customer acquisition, but also due to better repeat behavior that we're starting to see. In line with all those 3 metrics that we've shared, we can sort of deduce the GMV, which is this bottom row. And here you can see for the 9 months that have gone by, we've done 1,332 crores of GMV, which is up 236%. From the prior 9-month period of last year. I'll hand over to Arvind to walk us through combined metrics across the businesses.
Yeah, so this slide presents all the, thank you Adwaita, and big hello to everyone. This slide presents all the non-financial metrics or non-GAAP measures. And I think most of these you have already seen in the charts. So I'll not spend time on this and move on to talk about financial performance. So talking about the key highlights for the financial performance and starting from revenue. Like you heard from Falguni, this quarter is seasonally big quarter for Nykaa, and our revenues have grown sequentially by 24%. And also it has grown 36% year over year to cross 1,000 crore and is close to 1,100 crore. In this quarter, FY22, Q3 FY22. This is also a 65% year-to-date growth versus last year in 9 months. Let me explain the key components of this revenue growth. And as you would probably know that there are 2 different models that we operate. In inventory-led model, we recognize the net effective sales as revenue. And in marketplace model, we recognize the commission or take rate as revenue. Beauty is predominantly inventory-led model, and fashion is predominantly marketplace model. And you can correlate, therefore, these models into the 3 components of revenue here. The revenue from sale of product has grown 24% sequentially, quarter on quarter, and 31% year over year, and is driven primarily by growth in transacting customer. Talking about the second component of revenue, which is income from marketplace services, has grown 2% quarter on quarter and 154% year over year, which is primarily driven by fashion GMV growth. And then advertisement revenue, which is more a B2B revenue, which is combined revenue both for beauty and fashion, what we earn from brands, has grown 33% quarter on quarter and 53% year over year. And that's driven by recovery in brand spend on advertisement. So we see positive momentum in all 3 components of revenue. Talking about gross profit, gross profit has grown 35% quarter-on-quarter and 51% year-over-year, which also is in line with the GMV growth, which you saw earlier, right? So this is the line where both the models kind of converge together. So gross profit growth is in line with GMV growth. It has also grown 89% year-over-year on a YTD basis. If we talk about margins, gross margins have been reported at 46.3% for this quarter, which is a sequential improvement of 359 bips. And I have a chart to explain you the longer term trend. This improvement is led by share of high margin products and also higher advertisement revenue, which I explained earlier. Talking about the EBITDA for this quarter is 690 million or 69 crore, which is 6.3% at a margin level, and it's sequentially almost 300 bips better. So it was 3.3% last quarter, and this is driven primarily by improvement in gross margin, and it has grown 11% year-to-date basis. In terms of the key reason for decline in EBITDA margin year-over-year on Q3 versus 13.2 last year same quarter to 6.3 this quarter, that's because of increase in marketing expense. And as you would know that we were kind of muted spend on marketing last year due to COVID environment. So we had spent 7.5% of revenue last year same quarter, but we have spent 14% of revenue this quarter on marketing. So due to this, our EBITDA margin have declined year-over-year. But sequentially, it has improved by 300 bips, as I explained earlier. In terms of profit after tax, we are reporting about 29 crore of profit after tax for this quarter, which is a sequential increase. Last quarter we had 1.2 crore profit, but this quarter we have 29 crore. And on a YTD basis, it's 33.7 crore. On a YTD basis, profit after tax is lower. That's again due to higher marketing expense, as I explained earlier. Let me explain these trends through charts. First, showing the revenue from operation. The left chart are longer term chart, and the right charts are quarter-on-quarter. If I talk about 9-month revenue YTD, it's 2,800 crore versus 1,700 crore same period last year. So it's a growth of 65% year-over-year. If I look at the latest quarter, it is 1,098 crore versus 885 crore last quarter. So it's a sequential increase of 24% and 36% year-over-year growth. Moving on. In terms of the gross margins and the cost structure here, you can see that gross margin has shown sequential improvement last couple of quarters, and especially in quarter 3, because the share of categories such as makeup and premium or luxe category has also gone up. And apart from that, since the physical retail has bounced back, we have also seen uptick in private label share. So that's driving the improvement in gross margins. Talking about the cost line, marketing cost is 14% of revenue. This also includes some of the campaigns we did on brand building. Yeah, we can move on to next slide in a while, but let me explain all the lines. So because of brand building spend is 14% and slightly higher than last quarter. It continues to be much higher than last year same quarter because we are investing into building the brand and acquiring new customers. And the other two cost line on fulfillment expense and employee benefit cost, there's marginal increase, but they're kind of flat as a percentage to revenue. Moving on. Yeah, so if you look at the longer term trend on EBITDA, we had 2.1% EBITDA margin in FY19, 4.5% in FY20. Last year we moved the EBITDA to 6.4%. But this year YTD basis trending around 4.5%, which is similar to FY20 levels. And if you look at the right chart, quarter-on-quarter, it was 3.3% first quarter, 3.3% second quarter. This quarter it has improved by 300 bips to 6.3. The fundamental reason of lower EBITDA this year on a YTD basis versus last year is on account of marketing expense. As you can see that last year we had spent 6.9% on a full year basis and 5.8% on a YTD basis on marketing. But this year we have spent 13.1%. So it's more similar to FY20. It's actually 200 bips higher than FY20 also. So our EBITDA is kind of tending at FY20 level, but it has absorbed much higher marketing spend, which is also a conscious choice to infuse into growth, both the core business of beauty as well as the new business of fashion, and also some of the new verticals like Nykaa Men. The output of this spend we can clearly see in the transacting customer base, which is showing a healthy growth.
I think, Arvind, maybe we just come in here with some qualitative insight. So couple of insights were that financial year 21 first half was quite impacted by COVID, and as a result the marketing was kept at very low levels, and it picked up in the third quarter and fourth quarter, and the full year number was reflecting that fact that the first half was very small amount of marketing spend. However, besides that, the other thing I wanted to point out was that we also were behind the curve on total customer acquisition. So by spending more in marketing this year, we are trying to make up for a 2-year growth trajectory. And if you look at it from 19 and 20 levels, we used to spend 11.8% and 11.4% on marketing. And here, because also we are now building a mix of beauty and fashion. So clearly, I think while we have invested a little more in marketing this year to both in getting new customer, but also bringing back the repeat customer as well as building the brand. So on all areas of marketing, one is spend money with a view to long-term vision. And I think most of those are evident in our trailing 12-month customers as well as our annual visits and the unique customer visits. So I think it was an investment we believe was needed to cover up for the gap of the previous year. And going forward, I think there will be a more reasonable marketing spend on a long-term sustainable basis.
Yeah, thanks Falguni for chipping in. Should we move to next chart?
Yeah.
Yeah, so we have a PBT and PAT chart here. Talking about profit before tax, we have a profit before tax of 415 million or 42 crore versus 45.7 crore YTD last year. So it's 9% lower. Although EBITDA is higher than last year on YTD basis. The reason is we are investing into expanding our physical retail, and the lease cost comes below EBITDA, but it shows up in PBT. If you look at quarter-on-quarter trend, it's much higher number here for quarter 3, 37 crore versus 1.4 crore last quarter, and that is a flow down impact of EBITDA growth that I explained earlier. Talking about PAT, which is profit after tax, on 9-month period we have reported a profit after tax of 33.7 crore versus 43.7 crore on YTD basis last year. If you look at quarter-on-quarter trend, it's 29 crore for the quarter. Again, much higher than previous 2 quarters. And again, the key reason is that we have seen 300 bips improvement in EBITDA versus last quarter, and that has flown down to PBT and PAT as well. This is a summary of all our financials. Numbers are self-explanatory, but just to conclude that our revenue from operations for this quarter is 1,098 crore. Gross margin is 46.3%. EBITDA is 6.3%. And profit before tax is 37 crore and profit after tax is 29 crore. On a YTD basis, if we look at revenues are 2,800 crore. Gross margin is 43.5%. EBITDA margin is 4.5%. And profit before tax of 41 crore and profit after tax of 33.7 crore. And the key movement that we explained already, that if you look at marketing spend, last year 9 months it was 5.8%, and this year it is 13.1%. So it's almost 700 bips higher. And despite that, repeaters are now trending at about 4.5%, which is 200 bips lower than last year. But basically most of the marketing expense increase has been funded from improvement in gross margins. I'll end my presentation here. Saugata, back to you. Falguni, you have any concluding comments?
Yeah, I was just reading a question which was there. So also to address that. So one of the things I also want to say is that Nykaa is always investing in businesses of the future, and that does come through our employee expense line. So I think at the moment you all are aware that we are building a e-B2B business. We have called it the Superstore, and some amount of investment in manpower is there. I think it's had a good start. And going forward, we do believe in this business as a significant value add for the business. So I think what is happening is that from a business performance perspective, clearly this year we have spent more in marketing to cover up the gap of the previous year, which was COVID impacted. And we are also investing for the future in terms of building organization to be future ready. So yes, we can do more granular discussion in the question answer, but that's another area of investment I wanted to point out. Also on fulfillment costs, we were slightly adverse during the year because of COVID affected delays in our warehouse rollout. So clearly quarter three, second half of quarter two and quarter three has been the months when there was a further rollout of stores, there was further rollout of warehouses, and we've also announced that in the beginning that we created almost 20% additional warehouse capacity. And these warehouses also don't go to full scale of operation immediately. So we are definitely investing for the future, and that is showing up in our numbers.
Okay, thanks for Falguni and the entire Nykaa team. Operator, I think we can open up for Q&A now. If you can explain the rules of the Q&A, please.
Yes, sure. I'll just go ahead and I'll just request each and every attendee to rename them with their name and the company name. And one more thing, there is a raise hand feature. Whenever you want to ask any question, you just click on the raise hand. I'll just unmute you and you can ask your question. Thank you.
Thanks, Harshpreet. I think the first question is from Percy of IIFL. Can you unmute him, please?
Yeah, sure.
Am I audible now? Hello?
Yes, Percy.
Okay. Yeah, my first question is on the BPC GMV. I'm looking at it both on a QOQ and a YOY basis. So in order for me to understand the QOQ, it would help me if you could tell me what has been the normal sequential growth between Q2 and Q3 earlier, pre-COVID, how much has been the sequential growth in a normal year, generally speaking. And to analyze it from a YOY basis, I just wanted to know whether there are any sort of adjustments I need to make in the base, which is Q3 FY21. So on the one hand, Q3 FY21 was relatively normal, but of course it was still a COVID year, so there would be some impact of that. On the other hand, there might be some pent-up demand of Q1 and Q2 coming into Q3, and that would boost up the Q3 numbers. So do these two things offset each other, and is Q3 FY21 a normal base on which I can just look at the YOY growth? Yeah, so these two sub-questions in the first question, and then I'll go on to my second question.
May I just come in on a more strategic way of looking at this, and then maybe Anchit can come in on the details of the growth. So I just wanted to say that, as you're aware that the beauty business, the customer buys on an average 3-4 times in a year, or maybe 5 times. Of course, there are customers who buy 12 times, but I'm talking about the averages. And what we are looking at is we are looking at a cohort behavior, and finally what numbers make sense for our businesses are more we have a new customer and we have an old customer cohort and how those customers come back. That's how we look at the business. So I think what is most relevant is our year-to-date and a full year growth and full year numbers. And one should look at it from that perspective rather than really quarter-on-quarter comparison. Also because of COVID, exact comparisons are very difficult to make right now over the last 2 years, because there were periods when physical retail was shut. There were periods when even non-essential was not allowed, which means makeup was not allowed. There are periods, even this last quarter is not really a comparable to, previous years when there were a lot of weddings were postponed and many things were affected with Omicron setting in. So while for physical retail it was a good quarter in general, but I would definitely say that most of the quarters, there is not very good pattern that you are able to see right now on either sequential growth or even on a quarter-on-quarter comparisons on a year-on-year basis. And that's why we've taken a lot of trouble to indicate all the numbers, both quarter-on-quarter, year-on-year for the quarter as well as year-to-date number. I would also urge that the first quarter growth, and that's why we've given that also, the first quarter of financial year 23 versus first quarter of financial year 22 was a huge growth because the first quarter of 22 was artificially depressed with lockdowns and only essential business being allowed. So if you really want to look at longer term trend in beauty, which is a more mature business, I would clearly exclude that quarter and look at the growth for the rest of the period as a whole. So, take remaining 9 months of the year and that would truly indicate a growth. But even that growth would be slightly subdued because COVID did impact part of our consumption, and that is all coming back gradually, and it's likely to come back in a stronger way going forward. So that's on the beauty. On fashion, the drivers are slightly different because we were at a very early stage with less than 1% penetration. So most of the growth is coming from acquisition of new customers and getting those customers to get more comfortable with the platform and buying more often, and hence repeat customer behavior. So I think the two are being driven by two different, in two different manner right now.
Understood, Falguni. If you can just give one data point, if it is possible, that what is the normal seasonality between Q2 and Q3? I mean, if you look at your pre-COVID years, generally Q3 is higher than Q2 by how much as far as BPC segment is concerned?
See, by how much is a problem. One thing I can say for sure is that Q3 is always the best quarter, and Q4 finds it very difficult to match up to Q3 from a sales perspective, net revenue perspective.
Okay. My second question.
That doesn't mean that the profitability will be adverse because, as you know, in e-commerce, a lot of costs are variable marketing and variable fulfillment costs. So the only fixed costs that needs to be covered is the organizational costs.
Right. My second question is on any thoughts you have on international expansion. You have perfected this retailing platform, e-tailing platform as far as India is concerned. Do you think you can just take this e-tailing platform to some other countries as well as far as BPC is concerned? Because there are very few and far players globally who have done what you have done as far as the BPC segment is concerned. So any thoughts you have on that, if you can share?
Yeah, so there are interesting opportunities, but the main thing is right now that we have just begun our international foray in terms of first going into those markets with a view to export our private label brands, which we have many. So we are learning about these markets, particularly the Middle East, and also, also like markets like UK and then US. But I would say these are very early days, and I'll be able to throw better light maybe in next 6 months or so.
So these private labels which you export right now, they sell through other third-party retail stores, is it?
Yeah. We have a distribution or a retail partner in different markets. Like, for example, we've already entered Mauritius with a partner. We are working in Dubai and in UK to work with partners.
Okay. But nothing as of now in terms of an e-tailing initiative in international business. What would you say? I mean, if at all you would be willing to comment, what do you think would be a fair timeline on these 2 years, 3 years?
I think the international opportunities are clearly there. But, our success comes from having very customized platforms that really convert like no other platforms do. So we are not taking a very standardized horizontal platform to every country. So we think that may not work. So I think we are trying to be cautious and trying to focus on our domestic market, which I think offers huge potential at the moment.
Okay. Thank you. That's all from me, and all the best.
Thank you.
Thanks, Percy. Next up, we have Vijit Jain from Citi. Vijit, please go ahead.
Hello. Yeah, hi. Can you hear me?
Yes.
Yeah. Hi. Hi, Parveen. So I have three questions. First, so there's a pretty sharp improvement in gross profit margins, right? 46.3% and up 360 basis points sequentially. So I'm just wondering, how much of the improvement was driven by, beauty business, the e-commerce part, that is excluding the advertisement business and the impact that the fashion business, which is more marketplace. Excluding those, did the beauty business margins also expand? And is there a mixed thing there, or something else? That's my first question. And the second question is, what is your, for 3Q, what would be your own brand share in the beauty business?
No, so I think the first question I will answer as follows. Our gross margins are improving quite substantially, but it's also due to accounting, where in fashion, our net revenue is only the take rate or the commissions that we earn in the fashion business. And hence, obviously, the gross margin in fashion will be far better than gross margin in beauty. Having said that, there's been a good improvement in beauty margins also due to advertising revenues. And also there is a mixed impact that has played out. So yes, there is a combination of all of the three. But like we have disclosed that 25% of our GMV is now coming from fashion. And we monitor everything at a GMS level. But so I think we do believe that at a GMS level, the two businesses have very similar gross margin structure. And there is some improvement in those gross margins, but I think what you're seeing is also advertising revenue come a mix of fashion. Not possible to improve gross margin to this extent only.
Yeah, I'll just supplement that, Parvani. So as far as quarter 2 to quarter 3 is concerned, fashion has maintained its share in GMV and not, grown it disproportionately. So while as a longer term, fashion growing faster than beauty will have positive impact on gross margin, but that's not the case for this quarter. This quarter gross margin improvement is primarily driven from the factors like what Falguni said. In this festive season, makeup category and premium category like Lux brand share have gone up. Private label share has also gone up because physical retail is kind of back to normal in this quarter. And also because B2B revenue, which is advertisement, has also gone up. So those are three primary reasons of gross margin improvement.
All right. Thanks, Arvind. And my second question was, the own brand share of business in beauty.
Unfortunately, we don't disclose that, so it's not available. But we always say that we are a multi-brand retailer first, and we love growing all the brands on our platform, and we emphasize on bringing the best of what the world has to offer, as well as all of the great Indian brands on our platform. And you can see that in terms of, relative importance also.
Sure, Parveen. Thank you. And I'll jump back into the queue. We'll have follow-up later. Thank you.
Thanks, Vijay. Next, we have Avi Mehta of Macquarie Securities. Operator, can you unmute Avi, please?
Hi, am I audible?
Yes.
Yes, Avi.
Hi, thanks for this opportunity. First, I wanted to understand margin a bit. Now, with the focus coming on customer acquisition and, things normalizing, would it be fair to say EBITDA margin is going to be somewhere close to the range that we are witnessing for the 9 months as incremental gains are invested in customer acquisition and marketing? How should we look at that? If you could give us some sense.
I think, for us, the consolidated EBITDA margin is a composition of beauty and fashion verticals margins. And we do believe that, obviously, with scale in all these businesses, the EBITDA margins improve because of advantages of scale. And also the advantages that come in e-commerce are due to new customers as a percentage of total customers that do business with the platform. And those definitely improve with passage of time. So I think these are more determined based on how mature the businesses are, where beauty business is quite mature and fashion business is in the third year of operation, and it gets more mature, then that favorable economics plays out. If you have built customers in the right way where the returning customer engagement is high. So I think the effort will be to always move towards improved core EBITDA margin for each of the mature businesses. But Nykaa also has taken, decision to invest in new upcoming businesses that makes sense from a strategic perspective, and our Superstore and eB2B business is one in that direction. And while that effort has started this year, there could be investment going forward. So I think for us, it's a mix of balance between new and mature businesses versus mature businesses versus new businesses that we choose to seed.
No, Falguni, correct. So if because of this mix, would you kind of look at range bound EBITDA and focus more on sales growth? Is that the template that you're working with, is what I was trying to understand?
I think all I can say is that we always measure customer from a long-term value perspective, as well as whether incremental spends are adding to that long-term value creation. And we believe that the best way to do it is through a measured approach to growth, where the new customer acquisition is seen in light of the existing customer business that you have and the profitability of the business that you have. So I think we'll be dictated by that. We don't have a certain EBITDA number in mind, but yes, we definitely want to balance growth versus long-term growth versus short-term profitability.
Perfect. The second bit was essentially on the sales growth. Now this quarter we had the festive push plus clearly a stronger reopening. In that context, how would you judge the GMV growth in fashion? Is that, would you say that you're happy with this and it is more to do with, the focus kind of being on driving better unit economics as well as in this normalization as CAC goes up, etc. So I just wanted to get your thoughts on that, please. That's all from my side.
Yeah, so I think what has happened is that, like we told you, that we are always looking at the business from a year-to-date and annual perspective, and we are overall very happy with the year-to-date and annual growth that we've achieved in fashion business, be it in customer visits to be it unique customer visits to trailing 12-month customers and the orders that we are getting. I think within that the focus is always on building better returning customer behavior, and there are choices to be made on mix between returning customer and new customer acquisition and brand building. So marketing is spent in combination of that. So do you think we could have been happier with a slightly more growth in Q3 in fashion? Of course. But I think when we look at it from an annual perspective, we are quite happy with the growth and balance of profitability we've achieved.
Okay, perfect.
And I'll just supplement that. I think even sequentially, fashion and GMV has grown 17% this quarter versus 14% last quarter. So Q1 to Q2 was 14%, Q2 to Q3 is 17%, and it has crossed 500 crore this quarter for the first time. So it's quite a strong growth even on fashion.
Okay, and I'll also add there. I think, even for this past quarter in fashion, we've really been focusing on our unit economics and just striving towards building a business that is, heading towards profitability. So that has been a focus, and so to some degree, one could say that some amount of that growth is, we tempered the growth with the ambition of driving that profitability.
No, Adwaita, exactly. So the growth was, while the GMV growth, as Arvind pointed out, was healthy, it was the mix that I was trying to appreciate and understand. And how are you kind of looking at that? Because clearly, order volume growth was not as strong as it was earlier, and that's the thing that I was trying to appreciate or understand. Thank you.
Yeah.
Just if I may, from a bookkeeping point of view, I missed the comment on the fulfillment cost. Why did it rise? Given despite the fact that AOVs were up, I missed that comment, Falguni, that you had made at the start. That if you could just kind of.
First of all, the beauty split orders had risen during, the COVID. So if you look at it, like our revenues did not get impacted in April to June quarter of financial year 23, even though COVID was at its worst in the country, as you're aware. The Delta variant was at its worst, right? So a lot of warehouse expansions were slowed down, and the warehouse expansion started a little bit later, and the supply chains of many companies were also impacted, because of which, we had to manage with less than optimum inventory in various warehouses. So I think that has been since corrected by December, not just at our end, but also at partner ends, So with that, we do believe that so basically sometimes the packages were splitting and also traveling longer distance than they should travel because inventory was sitting in different warehouses where we had capacity, and many of the bigger metro warehouses did not have capacity. So I think that since has been corrected, and we do believe that it will be better going forward. This is for beauty business. And on fashion, the fulfillment costs were not adversely impacted. They are fine. They're the same. They've been improving slightly.
Okay, clear. Thanks a lot. That's all from my side. Thank you very much.
Thanks, Abhi. Next, can we have Jignesh from GMO? Jignesh,
hi, team. Thanks for the opportunity. You mentioned in the comment that we had one of the best best Pink Friday sales. Just want to understand, if you remove the Pink Friday sale, have it on apple to apple QOQ and YOY GMV growth in the BPC category?
I think, we have to calculate that and get back to you, but we don't think it was, I think the whole quarter was in line, and the quarter-on-quarter growth of sale and non-sale would be similar.
So our reliance on sale has not deteriorated, I am saying, because earlier our business model was more on the full price, limited amount of, you can say, discounted sale. That is not getting impacted, right?
Yeah, it's not getting majorly impacted. We monitor our annual sale for the full year during sale period and non-sale period. And it is not going adverse, but we must admit that we are trying to move to, sale during all the 4 quarters because of now being listed and need to not have a zigzag approach to sales. Yeah. But none of the sales will be as big as quarter 3 will always remain in India as the best quarter for the beauty business because of, Diwali, the Pink Friday, which is for the world is Black Friday. So all of that is getting bunched up in October to December quarter. So it's difficult to match that in every other quarter, but we will probably have a reasonably equal sale representation in all the remaining 3 quarters. Anchit, you want to comment on this?
No, I think you covered it. Q3 is, I assume for a lot of other platforms as well, Q3 tends to be the best. For this segment, there is a lot of event buying, and cosmetics is a category which does benefit from the wedding season. So yeah, I think you covered it. This is always going to be a good quarter for us, and it was a good quarter for us. For the beauty business, we showed you the numbers, so we feel quite strong. We feel quite good about the top line numbers for Q3.
Yeah, it's Diwali, it's the wedding season, plus it's the e-commerce sales that are done in that.
I'll just supplement that. So I think this quarter we had the annual Pink Sale event. So as last year, quarter 3. So it's like for like in that sense. Although, like Falguni said in over-archiving comment, that we still think that the marriages and celebrations are not at the same level. So of course we are benefited by festive buying, and Pink Sale is annual event. It was there last year also and this year also. The only a different element could be that we are still not fully out of COVID environment. As far as discounts concerned, if you look at our AOV, they are still 1966 in this quarter, which was 1976 last year, same quarter. So it's quite comparable. No substantial change in our approach on discounting. It's all brand funded, and our AOVs are quite healthy.
Understood. My second question on the fashion category. So since last 2 quarters, we've increased our advertising spend and everything. But if I look at the MAU growth and also the visit, on the QOQ basis is almost flat, you can say. What explains about that?
I think Falguni did cover this in the prior question, but I think, high level, 3 points. One is that we are looking at the fashion numbers on a year-to-date basis. On a year-to-date basis, you're talking about a 240% increase in terms of GMV, and a very similar number whether you look at, customers or other metrics as well. So from a year-to-date perspective, we're, very happy with the numbers. The second point is why the quarter-on-quarter has been a little bit, more muted at a 17% this past quarter, is because we've had our eye on trying to build things a little bit more sustainably, a little bit more profitably. It was, the markets were competitive from an advertising perspective, and I think at some point, for us in this quarter, the greater priority was focusing on driving a little bit more profitability and setting up the right cost structure even as we enter the next quarter and the next year.
But it impacted your visit and MAU also?
No, so I'll explain that. So what has happened is that we have started investing a little bit more on the upper funnel, what we call as a brand building investment, which has happened over last year compared to previous year. Like previous year, we probably had nothing on brand building. And that was clearly introduced this year. And some of that budgets do go away from lower funnel budgets. So, because we do try to manage for long term versus short term. So I think in that sense, we are at a very early stage. So by spending a lot more on marketing, by spending a lot more on upper funnel, and by just spending a lot more on marketing, can we drive revenues? Yes. But like we've always said that we like to believe that we should sustain a profitable growth strategy, which means that we should do marketing and advertising to the extent we can afford it.
Sure. I'll just supplement one point, here. See, if you look at fashion unique visitors, already 16 million versus let's say 20 million kind of number for beauty, 22 million. So it's quite sizable. So last 2 quarters we have, like Falguni said, we have been spending marketing to build the funnel. If you look at this quarter, we have focused more on convergence, right? Which is why the transacting customer base, it has gone up from 1.3 to 1.6, almost 25% up. So while you see a kind of flat number on unique visitors, what you also see is quite significant jump in transacting customer base or TTM. So you should analyze this in conjunction that we were focusing more on building funnel last couple of quarters. This quarter it was more of focusing on convergence, TTM and AOVs.
Understood. And my last question is, our marketplace revenue grew by 2%, but if you take about our GMV has been pretty good QOQ. So has our take rate, blended take rate in the fashion category has deteriorated, or any product mix change which I can say explain the lower, I can say marketplace revenue compared to the GMV, particularly in the fashion category?
So I think, to be honest, is this from Mr. Kamani? Then we'll have to come back to you because we have not really seen too much adverse in there. But there is only one part of the business that tends to have a very high GMV compared to net revenue, which is tech accessories category. So we'll have to study this and we can come back to you offline, please.
So any idea what is the marketplace GMV growth rate? So revenue is 2% GMV, right? Marketplace. Any context to the marketplace GMV growth? I'm talking blended, both combined, BPC and the fashion.
Actually, we don't measure it. I mean, we don't have those cuts or we don't measure it like that. I just wanted to also mention that, in this quarter, fashion private label has also done very well for us. And apparel share has gone up where we have strong private label. That's also a qualitative answer, but we don't have the cut that you're asking. As of now, we can come back.
Sure. Thanks, Aaron.
Thanks, Dignesh. Next we have Garima Mishra from Kotak.
Sorry, before we go there, I also remembered that we are also moving a little bit towards more, just a little bit of more SOR inventory also. So I think just comparing marketplace doesn't work, but we need to come back to you on what best we can do on those answers. Sorry. Okay, go ahead.
Thanks. Sorry. Yeah, Garima, please go ahead. But we have 15 minutes more, so we would request everybody to restrict their questions to 1 or 2 at best. Thanks.
Yeah, thanks for the opportunity. If I look at your YOY orders growth, that seems to have trailed the overall customer addition. When I say customer addition, it is essentially the transacting customer base that you've added on a YOY basis. And this we see both for BPC and fashion. So any particular trends that we can draw here? Is it really only a cohort issue?
Yeah, it is a cohort issue. So for example, the returning customer behavior was quite impacted during the COVID year. And since then it has come back, but it can go back to its earlier level and we are working towards it. But yes, I mean, to be honest, like to accept that there is no impact on customers' buying behavior because of 2 years of COVID, definitely at the margin there is some impact.
Understood. So in future quarters, is this something that you would again expect as the COVID period sort of normalizes, that you will probably add more customers, but your orders growth or revenue growth or GMV growth may sort of trail that number? Or this is only like a 1 quarter phenomenon?
Yeah, it could just be a COVID impact phenomenon, and that's why it's very difficult to read too much into all these numbers. In fact, what could happen is that for the same returning customer cohort, you could possibly do far more business also if marriages and all come back with a bang.
Got it. And I have one book.
So both going out as well as marriages are happening in a much more subdued manner, as you're aware.
Got it. Understood. And one bookkeeping question for Arvind. In the third quarter, was there any IPO expense that the company reported in its P&L? And what was the period ending cash on books?
Yes, Garima. So on IPO, actually, the accounting is like this. We had 88% share of IPO going to secondary portion, right? That's recoverable from selling shareholders. So it sits under the balance sheet, doesn't hit the P&L. For the 12% part also, most of it is adjusted against share premium. So it again goes in balance sheet and doesn't hit the P&L. Right? And in terms of cash balance, we raised a 600 crore net of expenses, of which we have utilized 170 crore towards the stated objectives. So 430 crore comes in the cash balance. We also had some cash balance before IPO. So as at the end of December, it's almost 800 crore cash in the balance sheet.
That's it from me. Thank you so much.
Thanks, Karima. Next, can we have Nihal Jham of Edelweiss, please? Nihal of Edelweiss, please go ahead.
Just checking, am I audible?
Yes, please go ahead.
Yes, thank you so much. Couple of questions from my side. On the private label part, what I notice, and this is an observation, that majority of our private labels are mainly in the masstige segment and above. Is it that to get better traction going forward, we'll be looking at more launches in the value segment? This is mainly for the BPC segment that I'm asking for.
So we do have some plans of coming up with a slightly lower masstige extension to our brand. But at the same time, we also have plans to take some brand execution more premium. For example, K-Beauty is definitely more as what you call as premium to prestige rather than masstige, you know. So we have most of our sales are at the middle in masstige category, and there will be some extension at the lower end, and there will be certain premiumization also.
Sure, that's helpful. The second question, just to better understand from my side, we mentioned about, obviously, at least in the fashion segment, a big proportion of the spends going in the upper funnel. But say spends which are meant for the lower funnel, ideally when you evaluate internally, is it that the focus for you is to get more visits, or is it the transacting customers that is the main focus in terms of those marketing spends?
No, I'm sorry to have communicated that most of the fashion is in the upper funnel. That's not true. All we said was that we did certain amount of TV spends this year compared to before. And if we were spending like earlier, only 10% of our marketing spend used to be in the what we call as brand marketing compared to performance marketing. That percentage has definitely increased during last year, because we also thought that that was a good year to get further momentum in brand building. So that is why the spend towards performance marketing as a percentage, absolute spends have all gone up, but percentage spend towards performance marketing was slightly lower than in the past.
Right. And just related to that was that when you do the spends, mainly as you said, on say customer activation or the lower funnel, as we discussed, that there, what is the metric that we internally look at in terms of the unique visitors, or is in terms of transacting customers? What is the key metric that we try driving?
So, there are three things we track. One is, how many app downloads that we achieve for each of the businesses. Then we also track of the app downloads, how many we convert to, to the customers in terms of actual buying, and that funnel is filled with, obviously there are customers who browse the website, add to the cart, but yet not buy it. And obviously then we come in with a CRM as well as what we call as a lower funnel spend, which is based on all those activities on the website. But if the customer is not naturally buying, we could also target through remarketing to bring those customers back to complete the transaction that they may have left in the middle. So obviously, final number is how many customers bought and how many customers we brought back as repeat customers and how many times in a year.
Understood. This is helpful. I'll come back in the queue for the questions. I wish you all the best. Thank you so much.
Thanks. Next, can we have Amit Sachdeva of HSBC, please? Yeah, Amit, go ahead.
So I just wanted to confirm one more thing. So while all of the app downloads don't lead to conversion, we don't call all of the app downloads as upper funnel. We call it performance marketing only towards performance marketing. So for us, the upper funnel is more brand building and a lot of content marketing and a lot of brand building that we do towards on YouTube and many of the upper funnel areas of brand building.
Great. Shall I go ahead?
Yeah, go ahead.
Thank you so much, ma'am, for taking my question. So coming back to the customer acquisition costs, and so as this has been pointed out, that number sequentially was flattish for monthly unique visitors, and obviously you have indicated that some lower funnel costs were lesser. But I was just want to understand from your point of view, as you are sort of in the year and you're going to the next one, is the larger focus is towards getting the existing users to spend more and more frequently, or the larger focus is to get more and more new users? And given the spend that you have done so far, how are you happy with the effectiveness of lower funnel spend in that number, although the transacting users are high but monthly users are flattish unique users? And is there a target you have for growth in those numbers next year? Is there a structural sort of expectation we all should model and build? Because I believe that would be the key driver. Monthly users converting to transacting users and order value. How we should think about this? Sorry.
Yeah, it is all of that.
Yeah, but what I'm asking is that given that it's flattish, how we should think about the future?
See, the point is, like I told you, that we look at it from the entire perspective of new customer addition that we add to the funnel, to converting them through the funnel, to bringing back the customers who have already bought in the past, to bring them back as repeat customers. Mm-hmm. And also, we also spend on content and we also spend on brand building. So all of that is a mix. And I think from our perspective, what we are trying to do is we are trying to balance balance the mix in such a way that we achieve a good year-on-year number for each of these categories. Sometimes, it is difficult to maximize that in every quarter,
So the reason, ma'am, I was asking was that is there a sort of a structural number we should have, like there's a 30%, 35% addition each year is possible, or is too much, or because these expectations, in my view, are being shaped and people will go by the year. But is there a structural trajectory that you as a business have in mind that somebody should model and think about, that the 30% or 40% or 20%? What sort of trajectory, according to you, is the realm of possibility, or at least viable, given where we are in the penetration and all those things? Is there a number you could help us with, or some guidance on that? How you think about this, or what you would say is a good number or a bad number? I just wanted to know that.
But can I come in here? So
Yeah.
we have got, let's say, close to 8 million. I'm talking about BPC, close to 8
Sure.
million transacting customer base, 12-month basis, right?
Sure.
Cumulatively, we have 14 million kind of number. Transacting base is 8 million.
Sure.
If you look at industry statistics, that tells us that there are 30 to 40 million BPC online shoppers.
Mm-hmm.
So there is ample and more scope for us to acquire many more new customers. Some of them may be showing up in our visit funnel. We have to still work on converting them to buy, but some of them may not have visited so far. That's also relevant for us. As well as, finally, if we also have a sizable customer base cumulatively transacted with us, but not bought in last 1 year, we have a task to also make them buy again. So like Falguni said, we are focusing on all three. Getting more visitors, because the industry has that kind of TAM. Getting visitors to buy and convert them into TTM. And also looking at our own base, captive base, and getting them to buy again. So all three are focus area.
Great. No, this is very helpful, Arvind. Thank you so much. I got it. I'll take it offline with you. Thank you so much.
Thank you. Maybe one last question. Tejas Shah from Spark Capital, and this will be the end, please. Thank you. Tejas, you can go ahead, please.
Am I audible?
Yes.
Yes, Tejas.
Hello.
Tejas, you're on mute.
Yeah,
go ahead, please.
Yeah, sure. Thanks for the opportunity. So my question pertains to marketing spend. How do we internally measure the effectiveness of marketing spend, both in short term and long term? And second, just an associated question. In just last 6 months since we have filed the RHP, we have heard almost all the online and offline retailers, big retailers, they have shared their rejuvenated plan to focus on BPC as a category. So should we think that our marketing spend from that line also, that it will remain elevated because competitive intensity will remain heightened, at least in the near future?
So I'll come in on that. So as far as the marketing spend is concerned, we consider it as total marketing spend divided by new customers acquired, and that gives us the cost of customer acquisition. We optimize for cost of customer acquisition, by categories, by brands, by if you're investing in new categories or new businesses. So, but broadly, it's what we measure is cost of customer acquisition, and we try to keep it in a reasonable level. We are also aware about the long-term value of the customer, and our effort is to try to break even on cost of customer acquisition versus the amount of money we make from that customer with the mix of how much they buy into gross margin that we earn on that. So I think this is what the equation goes on, and we try to do this at various category levels, various businesses. So there could be some experimentation on some business, and later if it is found that this doesn't make sense, then we will reduce focus on that. So it's a whole performance marketing is an optimization game, and it optimizes for categories, brands, SKUs, and so many things. So it's a very massive task, and that's why we are not able to give It's not like one switch, but it's mainly the optimization game at a very mass level. And you have to also keep adding to the upper funnel so that you have this constant base of customers, but only adding to the upper funnel also doesn't help. And obviously more you can improve conversions, and so it's a whole it's science and an art both together, if I may call it. But it's done on such large numbers that I don't think any competition overnight cannot affect the cost of customer acquisition, because both from marketing avenues, whether it is OTC platforms to short content platform to YouTube to general content or Instagram, Facebook, Google, and all of that against 5,000 brands, many SKUs. And then CRM for a company like Nykaa, the CRM is also a huge opportunity to keep bringing back our earlier customer. But what one doesn't want to do is that put all the efforts only on returning customer and not add to the funnel in terms of the new customer acquisition. So I think ideally one would like to have a certain percentage of customers every month as new customers, and keep adding to the new customer funnel so that you can keep benefiting from the cohort that those new customers generate.
And on competitive intensity?
So I think the competitive intensity, like I told you, the market is so large in both fashion and in beauty. If you look at fashion, like we probably entered in a very highly competitive market with Flipkart, Myntra, Ajio, Amazon already present, and still Nykaa is able to carve out a place at the right cost of customer acquisition. So I think both the industries are very big and they are growing very rapidly, and there is a massive growth of the industry itself. Like these industries are growing at 10 and 12% at the aggregate industry level, and within that the e-commerce is growing even faster and taking greater share. So I personally think that there is a place for everyone. Sure. And Nykaa will try to do the right execution that is long-term sustainable, profitable, and we will not chase only the top-line growth, but we will chase profitable, long-term sustainable growth.
Sure. And just the last
And because it's an optimization, it's very difficult to give a one-line single answer, honestly.
Fair point. And just the last one, so this pertains to the question that Jignesh asked earlier, and the gap between GMV growth quarter on quarter in fashion versus marketplace service growth of just 2% QOQ. So could it be the case that this time we had higher discounts in fashion, and that's why GMV has not trickled down to our marketplace services growth? Is that a fair understanding or misplaced one?
So, the point is to be really able to give you the right answer for this. We have to look into it because we are also expanding, categories across fashion, which you must have seen that we are expanding many categories within fashion. And also, like I told you that marketplace income is not the only indicator of growth. And yes, there could be higher discounts also because it was October is the festive season, but at the same time, fashion is also reporting higher AOV. So what we need to do is we need to also calculate the discount percentage that you're looking for and get back to you with a specific answer. So Ankit, if you note it down, we can get back to them with a specific answer. And if we have it, we'll also put it on our website for everybody to see.
Sure. Thanks and all the best.
Thanks.
Thank you. We'll close the call here. Thanks to the entire Nykaa team and everybody else for joining this call. Thank you.
Thank you.
Thank you.